Thanks for tuning in to Talking Point. I'm your host, Neeraj Shah. There were a few people who were bullish at the at the 8,000, 7,500 odd mark, looking into the future. And there were a number of reasons that they'd given then for why they were optimistic on the market, not necessarily on the economy, not necessarily on corporate health, but on the markets. One of them was Chakri Lokapriya. It's been a while that we've spoken to him, but I thought that now that we are nearing 12,000 and the uncertainties are moving up yet again, it'd be great to get his perspective on what could happen going ahead. So, with that in mind, I get him on the show. Chakri, so good having you. Thanks so much for joining in. Hope all is safe.
Good morning. Thank you for having me.
No, the pleasure is ours. Chakri, so you were bullish then. I remember in our conversations about you saying that this might actually be a good time to deploy fresh money. My question to you is now that we've rallied quite a bit and we have these uncertainties in terms of a second wave of sorts appearing in Europe, the US elections around the corner, and the biggest backstop to the market, which is the liquidity and the stimulus necessary, is now seeing a bit of wavering. How do you juxtapose all of that with the market positioning right now?
Good morning and thank you. And I think they're all very good points. From the March lows to now, thankfully, funds are up about 60 odd percent. And I think this is still the beginning because year to date numbers are still, while it's up 60 odd percent, year to date, the funds are up about, or even the market for that matter, is up about, let's say, a couple of percent maximum. So that is a below trend line number for a market. Now, usually during any pandemic, going back the last 100 years, there has been always a disconnect, both the domestic and the international markets, between the economy and as well as and the stock and the markets. So now where we are is we are at a point where I think the market continues to move higher. And because in terms of all the 4 points that you mentioned, will continue to act as a tailwind for the markets.
I've just used the earphones now because I think I'll be able to hear you better. Chakri, but the limited point is this. If indeed there are these uncertainties wherein the economic growth might be under a bit of question mark, and because we do not know what will happen when it comes to the stimulus measures from the US as well, is it prudent to exercise some caution at these valuations or no?
I think the markets will do. There's a good likelihood they will continue to do well despite the uncertainties of the U.S. election. I think at this point, and the U.S. election is assuming a kind of a Biden win with a GOP in Trump, so which means Biden would not be able to increase taxes. Anyway, that is which is a short-term positive for the market, and there is a U.S. stimulus, whichever party comes into power in the U.S., which will happen, which is a big number, a $2 trillion plus number. So that is one. Second is in terms of all the central governments, including India, are continuing to do what they can, both in the monetary and at the fiscal level. At the fiscal level, in Indian context, there's yet more to come. And as indicated by the government in the past, saying that they wanted to see the glide path of the COVID before they announce additional measures. Right now we still kind of wait and watch more on the moratorium of banks, but that will be an important point as well, probably November 2nd, as the government as the Central Supreme Court has pointed out, as to the trajectory of the markets. But markets are kind of decoupled from the financials which drove the Indian stock market to the other sectors which are now doing a catch-up.
Yeah, and the chat that we had yesterday, I want to dwell a bit on point number 3, and point number 4, and I'll come to that in a bit. But just because you mentioned financials, Chakri, just one quick word, because you track this space so closely, I know, from an investor's psyche, right? What do you think happens either on the basis of either side that the decision from the Supreme Court comes out on? Because there are a lot of judicial or official decisions, if I may, that will impact the banking sector, right? I mean, the interest on interest waiver did one thing, the moratorium on loans, etc., etc. So dissect this for us if you can, as to the outcome of a decision and the impact that could have on the investability in the financial space?
Well, I think there are two or three points here. One is the outcome of the decision, or rather the speed with which the decision is made, is more important than the decision in itself. Now, the moratorium, because that ends the uncertainty which the market has been grappling with for the last 3 months or so. Now, in terms of the moratorium for the small borrowers, I think that impact is highly manageable by the banks because it will probably be about 15 to 20 basis points of a hit. A number of the private banks, and including some of the PSU banks, have raised capital in anticipation of COVID related losses. So I think the bank balance sheets are strong enough. Now, in terms of what will continue to either for the market for the banking stocks to revive or to languish will depend upon the large borrowers case, which if it is left to the RBI and the individual banks, or rather the RBI, to come up on the interest on interest, then things quickly revert back to normal. Otherwise, they continue to languish. In terms of loan growth, I think those will continue to be fairly weak, given the recovery. But I think we should need to look past that, and the market will look past that and look at like FY23 or beyond, because the trend lines there will go back to normal. So are the bank stocks expensive at this point? No. Are the valuations okay? Yes. But would we buy them yet? I don't think so. Simply because the valuations have not traveled enough to say that despite the government uncertainty, Supreme Court uncertainty, will buy. So I think it's good to be underweight the banks for at least until November 2nd.
Interesting. It's just so uncanny, Chakri, that the conversation, even when COVID struck, was that go out and maybe try and buy some of the large, high quality private sector banks because those will continue to grow. And suddenly banks have just fallen out of favor completely. Nobody talks about buying an HDFC bank or a Kotak bank anymore.
Indeed, because usually in a market, in an emerging market like India, where the banks are key to, and banks on the financial system, whether it's banks and NBFCs, are key to driving credit growth at a corporate level, at a consumer level, and even at a government spending level. Now, when there and COVID, worldwide for banks, it has led to a hike, an increase in NPAs, an increase in provisions, an increase in slippages. All that is fine, but an executive decisions are more important, which drives the sector. I think that is the key for the sector, because when an HDFC bank, exceedingly well-run bank, but trading at some 3.5 times book, is not particularly cheap to live through the uncertainty of regulation, which we have seen has been postponed for the last 3 odd months. So I think that is key, because the underlying, what is below that of the judgment that comes out, will impact future borrower behavior, and that has been RBI's contention all along.
Yeah, well, judicial reach or judicial overreach hasn't helped any sector. I don't know if banking also goes through that. It will be an interesting point. But Chakri, the points that you made to me yesterday, and I want to pick up on two which seem very interesting and dwell on those a bit. First, you say that the third quarter 2020, which is the October to December quarter, I presume, will be the biggest turnaround quarter and will set the stage for future catalysts. Can you explain this point in a bit more detail?
Indeed. If we look at any past recessions or any past crisis, they usually either a demand shock or a supply shock. For various reasons, a demand the consumer or corporate weakens, and therefore they do not have the ability to spend. Or a supply or lack of supply of either food products or et cetera, leads to a spike in inflation. But now in this time, for COVID, you had an artificial situation where both demand and supply was frozen, not because there was a lack of it, but simply they were restricted because of the lockdowns. Now, as the lockdowns are eased both in India and outside India. India, mind you, was one of the harshest in terms of lockdowns versus the West. But as these lockdowns ease, then the demand and supply, which was artificially held back, comes back. And it comes back in a hurry, and that will translate into a restocking of inventory as well as some amount of demand, which will be the fastest ever in the recorded history over the last, let's say, about 50 odd years. Now that creates news flow, and that, of course, some of it is art looks like artificially high numbers because of or something which is stopped as like floodgates open and there's a gush out. But that news catalyst will continue on for several months, which is more than sufficient for a demand to recover, supply to normalize, and markets meanwhile to move higher.
Okay. Would it be broad-based, Chakri, or would you believe that the favorite sectors and the heavyweight sectors would show the base formation that is needed? I mean, what do you think? I mean, even in your assessment, when you're looking at Q3, you would have made some assumptions of what will stand out and what won't, right? So what are those?
I think it's not just the quarter, but even if you look a couple of years out, I think a couple of trends will remain, which is one, clearly IT and pharmaceuticals will continue to gain revenue and business momentum. And as they do gain that, the valuations for these two sectors will move up, and so will the interest of the participants. Now, in the case of information technology, basically, Y2K in 2000 was a big catalyst because both companies as well as clients entered that to solve Y2K, but then the associated revenue streams that opened up is what multiplied over the last 20 years. Similarly, now digital, and then connecting digital to cloud, cloud to enterprise, and enterprise to applications creates multiple revenue streams for sectors not imagined before, and that creates a huge revenue accelerator for the IT sector. Similarly, pharma, I think it has a number of catalysts. Now, then, so outside of these two, consumer. Now, both the consumer in India and outside India, when you lock them up and for 6 odd months, and again, as the unlock happens, some amount of spend will come back, and it will come back partly pent up and partly which is sustainable. So it is these three, and then the export-related sectors, all of them, whether it is chemicals, textiles, all of them will revive up. What will not or less likely to revive up is infrastructure, and banking will probably take some more time.
Okay. Just a couple of follow-ups out there, Chakri. Now, I'm just using names as examples. Okay, I was looking at, say, Tata Elxsi, right, which came out with numbers because large cap IT is providing the commentary. But I was looking at mid cap IT too. Tata Elxsi came out with numbers. The company, even if I assume a 14% YOY growth, which is what they've done in the quarter, I've extended it to the year. It is still trading at about 26, 27 times current year earnings. On a back of a 12-14% growth estimate, still trades at 24 times. So do you reckon that the wealth creation in mid cap IT or large cap IT would be a factor of valuations moving up higher from where they are right now, or do you think they'll surprise on the earnings growth?
In the case of Tata Elxsi, and this story repeats itself even to Infosys or TCS or the other names, which is you look at their EBITDA margin expansion. Now, the EBITDA margin has expanded, I think, to Tata's Elxsi to about 27.5%, right, which is a good 200, 300 basis points. Now, that translates into a higher ROE. A higher ROE mathematically translates into a higher PE multiple. And on top of that, you have a revenue momentum. And then, you right from the large cap IT to the mid cap IT, you have some number of expenses, which is, work from home has created its own headaches, but it's also cut some costs, travel, many other costs. Some of it is sustainable. Actually, these are not 1 or 2 quarter measures, but rather things which will sustain over the next few years. And IT, mind you, is in any case a short cycle. Before, the IT cycle lifespan was about 7 years, until which an IT company had to reinvent itself for new products and services. And that cycle is shorter. So it's probably about 3-4 years now. So I think the revenue path, growth path for Indian IT companies will support, and the multiples will expand accordingly.
Okay, so I presume that TCG Asset Management is a buyer in information technology. I mean, my question is not that you are bullish on the stance, because you may have bought it way earlier and you're riding the wave. Would you reckon they give a good investment opportunity even now, Chakri?
I would think so because, and yes, we will be buyers. We are buyers at current levels. We bought Infosys yesterday, and we'll continue to buy. If you take it, HCL Technologies still trades at 17 times. Yes, its margin is kind of lower, but in a path where the margins are expanding, that translates into higher profitability, and therefore there's more than enough business momentum to make the case for additional investments. And I think we will continue to add.
Okay. The other bit is pharma, Chakri, and I wonder where do you find favor there, because almost everybody's thinking about the API theme, but it surely can't be a one-trick pony, right? So, what do you think will do well? It could well be APIs, by the way, and you might well think that that's the space to bet on. But I'm just trying to get your sense.
Now, APIs is clearly very important. Indian pharmaceutical industry's main revenue thrust happens because of APIs. In addition to that, the various other categories, now you've seen a company like Strides. Now they have enough business momentum in terms of new product approvals in new disease categories, which will sustain their revenue growth from. And mind you, we don't have to. If you look at a common theme between here or IT, or even consumer for that matter, it is top line growth. It is not about bottom line growth. And top line is a very clear number. Now, in the case of pharma, I think now that will sustain. And second is COVID in itself. There are 7 billion people in this world, 1.5 billion people, 1.4 billion people in India. By the time they are vaccinated, a vaccine is found and they're vaccinated, that in itself is a 3-year story. So a vaccine requires a number of chemicals, a number of compounds to put it all together. It also requires medical devices, simple stuff like syringes and needles, but it's a huge enough industry to last another few years. And this will set forth another cycle because, the amount of research into health, infectious diseases, and which creates revenue streams, as well as the associated healthcare, like diagnostic labs. We have all that lot. I think we shouldn't ignore those. People have suddenly turned more health conscious because there is a change in behavior. Life insurance companies. I know I'm slightly deviating from the point, but all these are somehow all interconnected. We'll all see a new revenue streams going forward.
Okay. Chakri, the other point is, I mean, yeah, and I take on board your point. No, you are not deviating. All of these are in some ways or the other interconnected. Last question, really, and that is on whether you believe that 2022 in near normalcy would see only the favorites deliver results, or are there some dark horses wherein you are bullish, even if the street might be not?
I think 2022, it will largely be among these. And I think what we will look for is a business momentum and not necessarily a stock price momentum. I sincerely think that, as and when the uncertainty around banking ends, they will re-emerge as the main catalyst for both the market growth, and also it is very vital because they are the ones who supply credit to whether it's the corporate consumer or the government. And so I think once you go towards 2022, banking will again regain its business momentum, and also stock price growth.
Okay, Chakri, it was a pleasure talking to you today. Thank you so much for being with us and giving us your thoughts. Love the fact that you are kind of completely disassociating market returns with what the GDP growth would be, because that's the big burning question, right? And I also like the fact that you, who are completely bullish on financials, are saying that let's hang on, let's wait for the judicial decisions to be out and then take a call. Appreciate that. Thank you so much for giving us your thoughts.
Thank you so much. Thank you for the time.
And viewers, thanks for tuning into this edition of The Talking Point.